Welcome to Real Cash Flow, the only show that takes you full circle with your money, covering stocks, bonds, commodities, currencies, crypto, insurance, and real estate. I'm your host, Andrew Michael Arroyo. Let's get started. Welcome to the show. Today, we are going to do a market update and take a full 360 view of what is happening in the financial markets at large. A lot has happened in this last 30 days. It started off with tariffs no one expected. It came with volatility. It came with unexpected outcomes like the bond market reacting negatively, interest rates going up, the stock market plunging nearly 20%. Now we've seen a little bit of recovery, but end of the day, volatility is in the air, and we are seeing frenzy and uncertainty of what to do next. So the big question is, where do you place your dollars today? Before we get started, we're going to take a little trip down memory lane. A year ago, we started this podcast, and Real Cash Flow is the only show that takes you full circle with your money. We look at the stock market, we look at the bond market, we look at the currency market, we look at the real estate market, we look at the insurance market, we even look at the crypto market. Why do we do this? Well, taking a macro global view of what's happening in the financial markets allows you to drill down and find the best sectors to place your capital and time the cycle properly. Now, we are not day traders. We're not even swing traders. We look for long-term trends, and we find them by taking the 30,000-foot view and then drilling down on the specific assets that we can invest in that have a long-term trend line going in the right direction. Now today, first, we're going to cover the stock market and the bond market because it is the most sensitive of all markets right now. Whenever you see the VIX, if you haven't studied that, you can study the VIX, VIX. Whenever that goes over 20, that means that the market is acting irrationally. It's becoming very volatile. Now, we saw the VIX go as high as 60 recently, and that happened on April 7th when the tariff discussion happened in the bottom of the market. We saw a big freak out. People pulled the plug on stocks. We saw the NASDAQ, the Dow, the S&P dropping 5-6% a day, and individual stocks dropping much more than that. Now, traditionally, when that happens, people move their money out of stocks and they move into bonds, and that lowers interest rates. But a funny thing happened this time. Interest rates actually went up. They've continued to climb, which is alarming. That means somebody is selling off government bonds. Most likely, these are foreign asset holders, and they're moving into gold. So as we take a trip down memory lane and we look at these first podcasts that we produced, in May last year, we made a call. We made a call that commercial real estate was on sale, that commercial real estate is ripe for investment. And today in the studio, Nick Bonner is joining me. So Nick, welcome to the show.
Good morning. Thank you.
All right, well, let's dive into that first call. We're going to talk about our other calls later about precious metal, gold, and silver, and some of the other things that we had directed people towards. And just for clear disclosure, you have to make your own investment decisions. This is simply opinion, and we're just sharing from our experience what we're doing with our own personal capital or our investments. But Nick, is today still a great opportunity to invest in commercial real estate? Let's go back to the thesis, that white paper that you had put together forecasting what was going to happen with all the debt that's maturing in commercial real estate. And is it still a good window of opportunity to invest in commercial real estate?
Yeah, the short answer is yes. As I think back on this, Andrew, you and I first started talking about this opportunity that was coming back in November of 2023. And we started talking with investors and, late first quarter of 2024 about, our investment thesis, and then realized that we really should put this down on paper. And so I don't think it was till, May or maybe even June until we had published our investment thesis and started circulating that around with people saying that, there's going to be we're right now at the beginning of a really great opportunity to invest in commercial real estate. And here's the reason why. 42% of all debt is rolling from 2024 through 2026. And the lending world is constrained. The rates have gone up. Their underwriting is more stringent, and people that bought in 2020 through 2020, early 2023, are uh, in a very challenging situation with their costs going up in a lot of different categories, even beyond a rapid interest rate increase. And so, um, a lot of folks said to us, that's not going to happen. Like, none of those deals are actually going to surface. People are just going to kick the can. And we'd said, yeah, we do think people are going to kick the can, but there's going to be deals. And one thing that I've learned in plus or minus 20 years in commercial real estate is the best deals rarely ever see the light of day. Most often, when these things happen, a bank realizes that they need to dump some assets, toxic assets from their balance sheet in order to meet their requirements as a lender. And so they call up the broker and say, hey, who do you know that can buy this asset at a 20, 30, 40% discount, all cash? We need the money in 60 days. And that broker calls one client that they know is going to show up and is going to perform and not ask for a haircut at the 11th hour at the altar. And those are the deals that get made. They rarely ever see the light of day. And they are few and far between. And so, our whole investment thesis was like, how do we take advantage of that opportunity by, instead of being greedy and trying to just do one or two of those deals on our own, what if we went alongside lots of different partners across the nation who were probably hitting portfolio constraints, like they can't have more than 20 or 25% of their portfolio in any one deal. Well, they want to take down 600 unit deals. So they're going to need another capital partner to come alongside and co-invest with them. So therein lied the opportunity, and that was our investment thesis. Well, long story short, fast forward to today, here we are recording this April 24th of 2025. And yeah, we've just, even among our top four operators, we've already seen nine different deals that were, well over $10 million each, that were at minimum 20% discount, as much as 40% discount from their 2022 values. And we believe that we're still in the early innings of this ball game. How long it goes from here, nobody knows. I mean, initially when we were thinking about this, we talked about, gosh, it probably looks like 18, 24 months, but certainly what's happening right now in the macro economic environment, this looks like it definitely has more innings to play from when we had originally forecasted it. So yeah, there's a very big opportunity in commercial real estate. You've got to be careful with finding the right type of asset class and the right deals. Obviously, it's very much case by case situations in commercial real estate. It's just a very big world, but with um, the right investment thesis, with the right operators, with the right uh, uh, deal underwriting, there's an incredible amount of opportunity that's still available right now. Just to land that plane on this too, um, I haven't seen a great update from the Mortgage Bankers Association on this yet, but I did see something about a month ago where they said, yeah, uh, the can was kicked, and just looking at 2025 alone, 20% of outstanding commercial mortgages are rolling in 2025. And so, yes, the can continues to be kicked, but they can't do that forever. And so, even what we've seen, and I believe we've seen a lot of deals happen already, but I think there's just it's invariable. There's going to have to be more deals because lenders can't continue to kick the can forever, and things um, aren't getting better in the commercial real estate market. So the theme was in 2020, like late 23, early 24. I remember sitting in the cubes at CBRE, and the statement was survive till 25. If we could just survive till 25. And here we are. 2025 has not turned out to be, I think, the way a lot of people were hoping. And really, it's turned out to just be a lot more of the same. Interest rates are not coming down to the extent that people were hoping. Market transactions are not occurring at the speed at which a lot of people were hoping, and it doesn't appear to be getting better. And so that creates a very interesting opportunity for the acquisition of property because there's pain out there, and there's a very real chance to take advantage of that and as an investor and buy up some generationally solid deals.
Very well said. And a great call, Nick. And for those who want to rewind time and go take a listen, I would encourage you to go into our library in Real Cash Flow and go back to episode number 2. The title was Commercial Real Estate. Is this your window of opportunity? And that's when we released that white paper. And then we had several other episodes towards the end of the summer, number 8, number 9, and number 10. And those were titled Investing in Real Estate Syndication and REITs, and then commercial real estate is on sale! Explanation point, because we saw the falling knife begin there at the end of last summer. So please do take a moment, go educate yourself, and prepare for this window of opportunity. Because as Nick said, these are the early innings of real estate, and the opportunity is only going to get riper and riper. We haven't even seen the pendulum swing in residential. That's next on the chopping block. As those properties continue to build on the market and inventory swells, we very well may see some depreciation there. But it's not the same window of opportunities we saw in 2008 and 9 in residential. This is specific to commercial. And why? Well, it's a good segue into our next portion of the show. It's because of the bond market. What is happening with the 10-year and the 30-year? Whenever the 10-year rises above 4%, which as of today it's 4.3, the 30-year is 4.7. Whenever that happens, inevitably, that's going to put significant pressure on any operators that own real estate that purchased with yields at 3% or less in certain circumstances, or even 3.5%, because when you think about the move from 3 to 4.5%, it's actually a 50% move in interest rate in basis points. That's incredible in a very short period of time. So that cost of capital goes up tremendously. Now remember, what I'm quoting is the actual bond, not the interest rate. So these are the government bonds. The banks and the lenders are going to add their margins onto the figures I just gave. So today, with the 10-year at 4.3, is typically going to add at least 2 points for the mortgage lender's margin. So that's going to be more like a mortgage at 6.3. And if it's based on the 30-year at 4.7 as of today, that's going to look like a mortgage rate around 6.7. So dramatically different from what we saw just 3-4 years ago. Now, the bond market, as I mentioned at the early part of this show, traditionally will go down, meaning the rates will go down because people will pile into bonds. Remember, bonds are inverse, meaning the more money that gets poured into them, that actually lowers the rate. That didn't happen this round. And a lot of people are speculating that the foreign holders of our government bonds are not buying them. It could be retaliation because of the tariffs. It could be because they don't have the faith that they had 6 months ago in the U.S.'s ability to pay back these bonds, given our debt load. Whatever the reason is, bottom line is the trend is showing us that bonds are actually going up. They broke 5%. The 30-year broke 5% about 6-7 months ago. It touched 5% about 2 weeks ago. And if this trend continues, there's a good chance that we go above 5% towards 6%. That would be very bad news for the economy because, once again, the lenders are going to add 2, if not 3 points on top of that for mortgage rates or commercial rates for financing. So as we continue, I want to bring up something that's been a bright light in this whole challenging year that's been in front of us, and that is the precious metals complex. If you have not been following gold, especially, and silver, but gold especially, I'm going to encourage you to get your charts out and follow this precious metal. It's the only thing that kept me in the green with my own portfolio over the last 12 months. I was not exposed to equities and bonds and the fallout in both those asset classes, but I was overweight in metals. And I went over this in previous shows as well. I would encourage you to take a look at some of the shows like number 5. This is going back to last summer, and that was published in the middle of July, July 15th. And then we also covered precious metals very early on. It was our inaugural episode of this podcast. This was on April 23rd, show number 1, precious metals break out to all-time highs. And if you had rode alongside that call in April last year, here we are a year later. I want you to take a look for yourself, and you can see the appreciation. I'll go ahead and pull up our, I guess, most popular ETF that people invest in, and that is GLD. And if you look at what GLD has done in the last year, it's quite incredible. It's north of 30 or 40%. It's incredible. And SLV right behind it. SLV is the silver ETF. It has not done as well, but it has done okay. It hasn't kept up with gold. The big question is the run over at this point in time? And gold has had incredible volume. If you look at the relative strength index, a lot of people are forecasting that the fear is over at this point. The tariff talks have settled down. Gold very well may have a significant pullback. My suggestion is simply if you've been in that position for a year and you haven't taken some profits, you want to take a look at pulling some off the table. Again, not advice. You have to make your own decisions, but that's what I have done in my own portfolio. And for the record, I'm a SLV holder, and from time to time I go in and out of those positions, but gold has really stole the show this round. Okay, well, let's continue on, Nick. I do have some general economic questions I want to run by you before we proceed with some of the other asset classes. And it comes down to this. If I'm an investor today and the stock market is really scaring me, I've pulled money out of the stock market. I know many of my friends have. They've called me out, Andrew, what should I do? And again, I share my 2 cents, but ultimately everybody makes their own decision. And a lot of people just don't want the volatility. They're also not encouraged about putting their money in bonds or even CDs because they're worried about the debt load and the fact that we even had to introduce these tariffs because our debt is out of control, and can we even pay back these interest rates? So I'd like for you to comment on hard assets. Hard assets, they're physical, whether it's gold or whether it's real estate, they're tangible. And gold does not produce cash flow. That's the one negative of precious metals. At the end of the day, it's a nice storehouse of wealth. Bitcoin and crypto, the same way. You're really speculating. At the end of the day, there's no cash flow. But where real estate shines in environments like this is it's inflation resistant. And as prices go up, eventually real estate outperforms those prices and it provides some level of cash flow. So speak to the listeners about the benefits of why real estate very well may be the single class that the world moves into over these next few years as the equity markets and every other market continue with their volatility.
Yeah, it's a great point. I think if I were to try to sum up all the markets right now in one word, it would be uncertainty, right? Investors hate uncertainty. Markets can't operate in uncertainty. Even with bad news, they can sort of find their way. But that's ultimately we're in a very uncertain time right now, which is causing the market that you're describing to move so violently. Well, the nice thing about solid assets in real estate is, yeah, it has its bumps, but when you're seeking out things that have fundamental strength to them, they may see minor volatility from interest rates bumping or something, but the type of investments that we're talking about is buying things opportunistically, that that are well below what their value really ought to be. And so, take for example, multifamily, right? Because we're spending a lot of time focusing on multifamily. If you just take a step back, go up 30,000 feet and take a look at the multifamily market, put yourself in the shoes of the consumers, the renters. Um, the renters, if you were to just look at average monthly multifamily rent versus new home mortgage payments, your options are either to have a mortgage payment somewhere around plus or minus $3,000 a month, or to rent something around $2,200, $2,300 a month. These are sort of average numbers across the nation. I'm sure they differ from market to market substantially, but that's a pretty marked difference. And so if the primary customer has that sort of a pro con decision to make, it's pretty easy to start to understand why demand for apartments is so strong right now. And then um, you'll sometimes hear people say, "Well, wow, there's just been so much construction that's been taking place um, in multifamily, um, trying to meet that demand." But by mid 2025, multifamily construction starts are expected to be 74% below their 2021 peak. And that's simply because the cost of construction is going nowhere but up. It's incredibly expensive to build these things. Many of the deals that we're seeing surface on the multifamily front are because the owner needed to cut the flowers to water the weeds. They needed to um, uh, try to shore up a development deal that they did, a brand new Class A development deal, and they couldn't get the debt they needed, and so they sold one of their flowers, so to speak. They sold one of their their Class B multifamily buildings because they'd only take a 20% or a 30% cut or hit on that, as opposed to a 50% hit on their brand new developed deal in a market that for Class A may have more vacancy. And so all this is to say the cost of construction is exorbitant. It doesn't make sense in the short term moving forward for a lot of construction to be taking place, and so that creates a supply demand opportunity in the next couple of years that's going to be really sweet. And so we've got this temporary period where you can buy deals at discount, in large part because of a 500 basis point interest rate increase that happened back in 23, and um, and own a fundamentally solid asset that's producing cash flow that will more than likely have a really good 2026 and 2027. And there's real value creation to be made with some of these too, where a lot of these operators, they saw a huge increase in the cost of insurance. They saw a massive increase. I already mentioned the cost of their interest rate, but there's also inflation. So just general cost of repair and maintenance. Anybody that was trying to forecast stuff back in 2020, I just don't think a lot of inexperienced operators just didn't have a clue how much inflation was going to increase their overall costs. And if they weren't building that in to their underwriting, they ran out of cash. We've already seen a number of deals that came up to our attention as a result of operators that just weren't spending money on basic repairs and maintenance because they were out of money. And so that creates an opportunity to go in and buy otherwise fundamentally strong assets that were just being poorly managed and put a little money into them and get a really nice value add play out of them. And this is sort of a classic scenario of whenever a market's really good, you see a bunch of people jump into it. Well, that's what happened from 2019 through 2023. A lot of inexperienced operators were like, wow, this is my chance to make a lot of money. And the market has a way of shaking out those that are not as experienced. And so the experienced operators, this is why we continually say that, we want to invest with groups that have 10 to 20 years of experience and have been through multiple cycles, because when they're underwriting these deals and when we're underwriting their underwriting, we're seeing this, that they're planning for um, uh, what my real estate professor George Fermanian used to refer to as the black umbrella. They're planning for like bad days. And so if their underwriting tells you that if the bad is good, well, then the good's real good. It's another George Fermanian comment. If the bad's good, the good's real good. And so, um, as we're looking at these deals that have come across our desk, it's like, wow, there's a lot of opportunity to not only buy up the scenarios that I just mentioned, but there's also opportunities to even get into some of these like newer construction deals. We got to be very careful about the markets that we're buying in, by the way. But some of these opportunities, you can get newer constructed or brand new constructed properties where the developer just ran out of gas. They just ran out of capital, and you can come in and get them at a substantial discount to what anybody could build that thing for in the next 5 years. And so uh, you're getting you're buying something that's value is ultimately going to go up. You're getting um, cash flow in the process, and those that combo is a very attractive combo for a lot of investors who want to be able to see cash flow and an overall valuation increase as well.
Well, we appreciate your expertise, and there, in my professional opinion, is not a better place to park capital over these next few years than into discounted commercial real estate assets that cash flow. You have an opportunity to get a substantial lowered cost basis and then to build off there as the market will inevitably recover. Now, as we wrap up the show, we're just going to cover some of the other asset classes. We're not focused on them right now because, frankly, not a lot is happening. The first would be the energy complex, the commodities like oil and gas. There's just not a lot of movement there. If anything, there may be downside. And everybody anticipated there was going to be all this drilling and this is going to drive up energy prices because of inflation, and but we had these big reserves, so we would be able to drill. Well, none of that has taken place yet. It's too early into the term. And the other problem is here's crude oil trading at $60 to $70. It's super low. If we get any type of deep recession, we could see that pull back to 50 or even 40. So nothing's really happening there. Same with grains and same with the currencies. Certainly the dollar has taken a huge hit. There was a scare with Fed Powell being fired. That's all kind of settled down now. But the point is that the dollar in general, if you look at what the dollar's done over the last few months, it's fallen about 10%. And that is indicative of the near future and governments in general not feeling like the dollar is the place to be. So keep your eye on the dollar as we move forward. Crypto has had a hit, and we've seen that come down. If you want to know how crypto moves, pay good attention to the NASDAQ. As the NASDAQ goes up, which is tech oriented, so does crypto. And when the NASDAQ falls, so does crypto. So finally, I would just say there are some headwinds coming to the real estate home builders. We've seen substantial discounts. We've seen this in the insurance stocks as well. REITs, ironically, have really held up on the stock market, but the home builders, we're seeing less building starts. And in insurance, with the disaster we had here in California recently, the wildfires, and just the increase in premiums and rates and risk, insurance in general is not a place that we're recommending. Other than that, Nick, I just want to thank you for being here and sharing that insight. We're all looking forward to the next white paper to see how long they're going to be able to kick this can down the road. So what's the next shoe to drop, and is there further downside in the commercial real estate space? So any closing comments as we wrap up today's episode?
We mentioned this in our white paper a while back. It's a famous Mark Twain quote that says, history doesn't often repeat itself, but it does often rhyme. And so as we're looking for those notes, just stay tuned, because we've got a lot more thoughts coming, probably a revised white paper that gives an update to our original investment thesis. And we're glad that you took some time to listen. So thanks for being a part.
Excellent. Well, without further ado, we're going to wrap, and I would just encourage you to take a look at our library. There's a lot of useful information that we published last year that will set the precedent for what is coming down the pipeline as far as where to park your money and how to generate cash flow. We hope the message has blessed you, and have a wonderful week. We'll catch you on the next episode.